So we are ready to start with this special webinar we have for today with a different subject from all the subjects that we used to have here at FX Street. We will talk about today automation, automated strategies. And we are going to focus these automated strategies through Elliott Waves and Fractals. Yeah, that will be our base to try to build up at the end of this webinar an automation that works, that gives positive results. So if you have any question during the webinar, you can just text it in the chat area. You have one chat button there that you can just comment and add your questions there. I will be checking this constantly. If you have doubts, you can stop, and I will try to solve them. And okay, you have the financial forecast website there. So I will start sharing the presentation for today. Okay, perfect. So let's move forward. What is the plan for today? So we will make a quick, very, very quick intro because we have a limited time. And we will review the top guidelines to identify waves. We will go through all the history from Elliott Waves till Mandelbrot, fractals, and so on. And from my point of view, what are the top guidelines that you need to follow to identify waves properly? Yeah, there is a lot of subjectivity there that we can't avoid if we know what we are looking for. So that's what we are going to find out there. We will explore 10 basic patterns. Coming from one pattern that you will see later, we can with that create 10 different patterns that we will try to find out in the different instruments. Then we will use indicators to determine trend, volatility, and other characteristics that is behind every pattern. I give a special behavior, special characteristic that will define that pattern for that specific instrument. Then we will go to money management rules. In every automation, when we are building an automated system, we need to have clear how are we going to manage our money, where do we want to put the stop, where do we want to take profit, how much are we going to risk. Because depending on that, a successful strategy can be a really bad strategy and you can lose money out of it. So that's why it's a very important lever that you need to control in order to have success with what you are doing here. And then we will go to the automation itself. I will show you an example of how the optimization process should work and all the different things that you need to keep in mind in order to make that optimization uh, accurate, profitable, and successful. Okay, are we ready to go? If you have any question after the webinar, because you are too shy, you don't want to to share it in the chat box, or the questions they come out tomorrow when you are reviewing the webinar, so you can send it at info@thefinancialforecast.com. Any question you have, I'm more than welcome to solve it. And of course, if you want the PDF of the presentation for today, you can have it, just request it to the email. Okay, before we start, we already said it. We will use a strategy builder. It's in our website, so you can check it there. And if you want to deep dive, also you want to have 20 minutes one-on-one with me, it's perfectly fine. We can do it for free. The only thing that you need to do is book the day. What is a financial forecast? It's very simple, so we can move forward. We have a clear mission that is create financial technology to improve investors and traders' lives, in the end, people's lives. And we also want to use the power of this technology that we build to support and help those who need. And of course, we believe that the financial markets, are fractals, and those fractals reflect the emotion, the behavior of all the intervenants in that instrument or in that market. That's why we can find patterns and we can use them to invest in the future or to foresee what is coming. Okay, that's me. Let's start with the subjects. When we start talking about waves, when we will hear about waves for the first time, that was with the Ralph Nelson Elliott in 1930s. He took the down theory, he deep dived on it and created the Elliott wave theory that has really is a really great foundation for concepts that will come later. But especially we will see today, well, from my point of view, the best discoveries from this principle. The first one, he defined the financial market, in this case the Dow Jones, as a fractal. That means that we will have a simple pattern that repeats itself infinite times at different scales to create bigger pictures of the same. And for this to happen, he needed to establish some rules. So we have 4 rules that are very important, especially if we want to identify waves properly. And the first one, it says wave 2 must not exceed the start of wave 1. This is super important. This is really key if we want to identify waves properly. If we are working with 3 waves, if we are working with 5 waves, with 7 waves, doesn't matter how many waves are we using, it's very important that it's happening always this. This is the beginning of the wave 1 at this point here. The wave 2 in this case is the corrective one, and it never exceeds the beginning of the first wave. Yeah, so it can never happen this. Okay, we can just bounce at any moment, but never wave 2 retrace more than 100% of the first wave, wave 1. If this is happening, then that means that this wave is not a wave 1. Okay, that's why it's very important, this rule. The second rule, the wave 3, is never the shortest of waves 1, 3, and 5. This is if we are working with a 5-wave pattern. The wave 3 is never the shortest one. So that means that we cannot never have this and say that this is a 5-wave pattern. We have 1, we say 3, and we say 5. In this case, this is not true. This cannot happen because wave 3 is shorter than wave 1. And it's shorter than wave 5. So this can never happen. These 4, 5 waves patterns. The third rule, wave 4 never enters the territory of wave 1. Again, we are talking about 5 waves pattern. So we have wave 1, wave 2, wave 3. Yes, wave 3 is bigger than wave 1, so we are respecting the rule number 2. We are respecting the rule number 1 because wave 2 doesn't exceed the beginning of wave 1. And wave 4 cannot do this, enter in the territory of wave 1. This is the territory of wave 1. Wave 4 can never enters. If we see a wave entering this area, that means that this is not a wave 3, of course, and this is not a wave 4. Okay, we are talking about a different pattern. Then later we will simplify this because it looks a little complex at this moment. Okay. And the last rule is that wave 2 is never a triangle. For Elliott, a triangle needs 5 waves, 5 internal waves. So for this reason, we cannot see this 1, 2, 3, 4, 5, and then the wave. Yeah, this needs to go a little down. Okay, just to have the triangle. This can never happen. So this is not 1 and this is not 2, because 2 in this case has the shape of a triangle. So this is not valid. Okay, important to know all these rules. Yeah, if we can manage these rules properly, then for us will be easier to identify waves and even to identify simple patterns. Good. Also, we'll see later, he connected this principle, the waves, with the Fibonacci sequence, and that's also a very important incorporation to the analysis nowadays. So then Elliott described not only the five-wave patterns that we described before, but yes, also the zigzag. And he realized that the zigzag can combine up to 5 times, up to, 3 times, creating something similar to a 5 waves pattern. I will show you. A zigzag is formed by 3 waves, A, B, C in this case. 1, 2, 3, 4, and 5. So in this case, we also have a 5-wave pattern, but it's built with zigzags. And of course, the rules that we saw before are not valid because in this case, the wave that is in the 4th position is entering the territory of the first wave. Yeah? But the internal subdivision is on 3 waves. That's why we call this a triple zigzag. The zigzag is the most important pattern that you will find in the different instruments in all financial markets. Yeah, this is your key, and we will see later why. But also you describe this 3-wave pattern, and with the extension to create like a similar of the 5 waves we saw before. The next great discovery, of course, is the incorporation of the Fibonacci sequence into the wave analysis. So we can analyze the waves in length and in time also. But now here we will focus on the length, in the length of the waves. Yeah. So we can analyze this length using 2 different tools. The retracements, when we are analyzing the corrective waves, and extensions, when we are analyzing the next motive wave. In the case of retracements, so we're saying we have here in this sample, we have a first zigzag ABC. Yeah, this is the right nomenclature for Elliott is the wave W when you have ABC. But let's not make this complex. Let's focus on the 3 waves. We have an ABC, 3 waves. This pattern is complete, and then the correction is in place. So the area where we can expect the end for this correction is an area connected by the Fibonacci sequence, yeah, the ratio of Fibonacci between the 0.382 and 0.618. This is the most common area. Of course, we will have more levels where this retracement can finish, but this is the main area where retracement used to happen. Okay, from 0.382 and 0.618. And these ratios are taken from the Fibonacci sequence. Yeah, the Fibonacci sequence is 0, 1, 1, 2, 3, 5, 8, 13, and so on. So the ratio between these numbers, the contiguous numbers, give you 0.618 or 1.618. Yeah, and then if we go deeper, we can find the 0.382, 0.236, 0.146, and so on. It's important to know some levels more than the classic one, okay, 0.382 to 0.618. And once the corrective wave is finished, so we can foresee or calculate where can we expect the next motive wave is going to end? And for this, we use what is called an extension. We take the length of the first wave and we extend this from the end of the corrective wave. And we can have 0618, 1382, and different levels following the Fibonacci sequence. The most common level will be the 0.618, and then we will have the waves finishing close to the equal waves, yeah, to the one area. But it's really, really a great tool that you will use a lot to analyze the length of waves. Any question by far? Good, everything is clear. So why I'm showing you this? Because these rules, these are the rules we are going to use to build our automation, okay? The next slide is another great discovery, observation from Elliott, and it's the alternation. Alternation happens all the time in financial markets, and it's a reflection of our psychology in the end. That is saying, I call this really a golden rule because it happens continuously in the financial market, and establish the expectancy of differences between similar waves in length, time, speed, and construction. This means that if the first wave, to go back one, if the first motive wave have a simple construction and we cannot find subdivisions, then we can expect, or we have more chances for the next wave, motive wave, to have a complex structure. And yes, just see the subdivisions. And if this happens, then for the next motive wave, we know that it's not going to happen. We have more chances of not occurring the same as in the prior wave. So if the prior wave was complex, then the next one can be very complex or can be simple again. But we won't see, we don't have too many chances to see the same kind of structure for the next wave. The same is happening with the length in this case. And the construction. So Elliott mentioned this especially with the corrective waves, and he said if the first wave, corrective wave, is a zigzag, then we can expect that the next corrective wave will be flat. And the same, if we have a really deep correction in the first corrective wave, then we can expect a shallow correction in the next one. Okay? Same happens with extensions. If the third wave was an extension, then the fifth wave is more likely to happen that it will be is the similar length of the first wave, so it's not repeating the length of the middle one. And there is a pattern that happens quite often, that we will have a first wave, the corrective, a third wave shorter than the first wave, a correction. And if this happens and we have a reaction, the highest probable scenario is that we will see a wave that in length will be bigger than the first wave. And this is due to the alternation also, because this we have a combination of 3, 1, 2, 3, a correction, and then the next wave. So this is the same as saying that we have 3 waves. Okay? But alternation is key. Try to don't expect the same for the coming wave. And now we move to 1980s with the definition of fractal. Fractal was defined by Mandelbrot, a French mathematician, at the end of the 1970s. And with this, he described the different patterns that you can find in nature. There are simple patterns, as we said before, that repeats infinite times to create the same picture at different scales. And financial markets, as Elliott described before, they are fractals. But for that, they need to fulfill two very important characteristics. One, they need to have fractal dimension, and then the next one is they need to have self-similarity. Both are there in the financial market, so that's why we can incorporate them into the fractal set. And the pattern that repeats continuously is not the 5 waves that Elliott mentioned before. It was very elegant and very nice to fit also all the Fibonacci sequence within every pattern. But the truth is that the financial market iterates in 3 waves, in zigzags. That's why Elliott was able to see this triple zigzag. Yes, this extension in the zigzags, similar to a 5-wave pattern that he described first. But then we have the zigzag repeats itself in length, as we can see this in the second image. But this is not enough to get the picture or a similar picture of a financial instrument. That is because the length is not the only thing that is iterating. Also, the time is iterating, it changes. And then is why we call the financial instrument as multi-fractals. Why? Because we have these two elements that are iterating. The length on one side, as we saw with the Fibonacci sequence, the retracement and the extensions, but also time is connected with that length. And the time, we have waves that go faster than other waves, sharp waves and very slow waves. And this iteration of time is what is creating also the volatility in the market. So when changes happen fast, waves are moving faster. And then we have something similar of what's happened in the first area. So if the wave moves faster, then in this graphic, the third graphic, we move to the left side. And if we move slower, we move to the right side. What I'm saying with this, when we break the balance, we have a balance between price and time. And that will give us a 45-degree angle. Okay? When we break that balance and time goes faster than price, then we move the graphic or the wave to the left side. And the opposite is the time goes slowly. Yes, we move the wave to the right side. And that will have consequences also on how the corrective wave will develop. Yes. Why? Because if we have a very fast wave, we can expect a very slow corrective wave. And the opposite. Okay, if we have a slow motive wave, then we can expect a fast corrective wave. Yeah, this is not always happening, depending on the instrument, depending on the pattern, but this is a general concept. Okay, and this is what we see also as volatility in the market. This is very, very important to understand because this will be the foundation of our automation. And here we have an example of how the different waves at different degrees are connected not also in time, but also in length. And here we have the different relationship in length and the different relationship in time. And we can see most of them are close to Fibonacci ratios. Yeah, and that is really important to understand at the time, at the moment you are analyzing the financial market, at the moment you are building an automation. This is our foundation. But it's not only about length and about time. This is the first step uh, on how we are going to define the behavior of each pattern. We also need to capture more characteristics. Yeah, but the time and the length are two very, very, very important, as we will see when we were preparing the automation. As we said before, the wave Y, in this case, the third wave, will be connected with the, the prior motive wave by the level of retracement, by the time balance. Yeah, we have the wave W and the wave X, and other factors that will define that behavior, like persistence, volatility, and trend. Yeah, these are the three elements I like to work with to define the behavior of each pattern. And this you can find in my book. It's in Spanish at this moment. It's Las ondas de Elliott, el comportamiento fractal en los mercados financieros. And we will show these patterns. And this happens most of the time. If we have a correction finishing between the 0.382 and 0.5, then the next motive wave used to find the extraction, the end, between the area of 0.5, 0.618 extension of wave W, and used to finish around the equal waves when the retracement is deeper, between 0.5 and 0.618. And you have different patterns, and you can find also different levels of behavior. But these are general rules that happen most of the time. So we have here a nice foundation for our automation. One side, we have how to identify waves, the rules we are going to use to define motive and corrective waves, how we are going to connect those waves, length, time, persistence, volatility, and trend. And now we will see the different patterns that we can build using just a simple zigzag. And what we are going to use here is the alternation rule to define 10 different patterns. We will start first with the simple zigzag. We will have a first wave, simple, a corrective wave, simple. Yes, and then we expect a third wave, the wave Y, also being simple or more complex. But we will use only two waves. It's a very simple pattern, and of course, we will find more of these patterns in every instrument, in all the different instruments. Let's say we will work later with the pound dollar, but this is applicable to any financial instrument, to all the financial instruments. So we have this simple pattern, we will find more. While more complex is a pattern, then we will find less amount of patterns, less chances to invest in the market. Yeah, the more simpler, we find more, we can invest more. It's up to us to find the right pattern to make that strategy profitable. But we will have more opportunities there. Then the first motive wave can be complex. The corrective wave can be simple. And then we expect the third wave. Then we'll have the, depending on how they are structured in the first subdivisions, I have something called type 2. In this case will be shorter, and the corrective wave will find the end around the third motive wave of wave W. Then we have the type 3 that will find the wave X will find the end within the first motive wave in the wave W, within the wave W. Okay, and then we move to the next wave. We have a simple motive wave W, and then a complex corrective wave X. And here we can see that the time that this wave X will need to be completed will be much higher than the time used spent by wave W. Yeah, so in these cases, we can find this what we mentioned before, a long and a shallow corrective wave. Also, we can have a principle of a triangle in the corrective place. Okay, we have a simple wave W, but also a complex corrective wave that can end. This can end in a triangle, or can continue the developing of the third wave. Then we can find both complex, motive and corrective. Just remember, we are using only zigzags here. We can find a lot of variations thanks to the alternation mentioned by Elliott. And this is my favorite pattern. Why? Because it's similar to what Elliott mentioned. Here we're talking about the zigzag. The wave W has internal subdivision following the alternation. The first wave is simple. The correction, the third wave is complex. This we complete W. And then we have a simple correction of wave X. Okay? This is have total of 5 waves. Most of the pattern used to finish on 7 waves. Yes? Remember those numbers, 5 and 7. 5, most of the time, not always, means a continuation. And 7, a potential ending. So it means that we have more chances here to see the next wave. And that's why this pattern is one of my favorites. We have a little of everything there. And then we will move to the very, very, very complex patterns. We will find this, not many. And we have a complex wave W, yes, with a 5 wave subdivision, and then a complex corrective wave in 3. And then we'll have the last pattern. We'll have a zigzag for the wave W, but a very complex corrective wave X. Yeah, we have a simple first wave, first motive wave in the correction, within the correction, and then we have a complex third wave to complete that correction. Everything is clear with all these patterns. We are talking about a lot of patterns, total of 10 patterns. And then we need to connect them in length and time. But also, we need to define the trend, the persistence, and the volatility. For the trend, we need to detect the direction of the motive wave, and we want to follow that direction. For persistence, we're talking about the fact of continuing the trend. What are the chances of that trend to continue developing? That's really, really important. And volatility, we're talking about the size of the changes. For trend, we can use price and a moving average, 2 moving average, period points. And I like to introduce as an oscillator here the MAC that is built with the cross of 2 exponential moving average. Then for the persistence, this indicator is really good. You can really find cycles here. And it's called the fractal dimension indicator, or FDI. And finally, to define the volatility, I like to use Bollinger Bands, the ATR. This is a proprietary indicator we have in the financial forecast called the spectrum indicator. This is really good to find the exhaustion of movements. And we can use also the stochastics to measure that changes in the in the candles, yeah, in the periods that we are analyzing. We'll use some of these. Well, in the automation, I like to use 1, maximum 2 of these. Yes, but with 1, it's more than enough to find out that footprint that we need for the trend, for the volatility, and for the persistence. but we need one element of each, yeah, to define perfectly well the behavior of the pattern. Question by far? No, is it all clear? Good, I'm happy to hear that. Now let's jump in another piece that we need for our automation. This is the money management. What are the rules that we are going to use for money management? So we have here an easy schema of where can we enter, where we need to put the stop, and where we can take the different profits. This, in the end, is a plan. And you need a plan if you want to invest in financial markets. But also with that plan, we need to define the risk, how much we want to risk per transaction. And the recommendation is always go between 1 and 2%, no more. Because then you have a big risk to lose your money, to lose a big part of your money, and then it will be harder many times to recover that money lost. So always the healthy is 1 to 2%. We need to have, of course, a stop loss. We cannot invest or trade without a stop loss. We need to know, we need to tell our system, to our automation, when we need to move out because the pattern we thought it was there is not the right pattern. Okay, and that will happen. There is no a perfect strategy. Yes, we will have patterns that will be confused with the right ones and will create losses. But that is part of the strategy. But we need to say when we need to move outside. So we can use the beginning of the first motive wave, in this case wave W. We can use the end of the corrective wave. Yes, we can use middle points if you want. But these two are really key because they fulfill, they match with all the rules we saw before to detect the different waves, to identify the waves. So we know at the moment we break the beginnings, the pattern switch. Okay, that's why these are really key areas where you can place a stop loss. Take profit, we saw it before. These areas 0.5, 0.618, equal waves, extensions. Yeah, we have different levels where we can take profit. How many times are we going to take profit? Are we going to take profit only once? Are we going to take profit twice? Here, here, or here, here? Yes, that is up to us and to our strategy, but we need to define that at the moment we want to build our automation. Then, leverage. This is also very, very important. We will discard the martingale strategy. So this is not allowed. Yes, this means that we will double every time that we have a loss position. We will double the amount of money we are investing in that trade. So this is not allowed. We will never follow a martingale. But yes, we can choose between two different leverage systems. It can be symmetric or asymmetric. In our automation, we have the two options. Yes, if you want to compound your investment, you will need to follow an asymmetric strategy. Because every time that you will earn money, you will get profit, you will reinvest those profits in the coming trade or investment. And symmetric is all the time you will invest the same. Doesn't matter if you win or if you lose. Yeah, from you have a starting point. If you have 10K, 10,000, yes, and you want to risk 1% of it, so we are risking 100. Okay, why we risk 100 all the time? Yes, doesn't matter if I win or if I lose. For this, we need to find in what moment we want to review that risk, when we want to increase it or when we want to decrease it. And the asymmetric is happening all the time. That calculation happens always. Okay, but important, risk, 1 to 2%, stop loss, take profit, uh, uh, the leverage, and of course, don't follow a martingale. Good. And from this, you can make a winning strategy, losing strategy, or the opposite, a losing strategy, a winning strategy. That's why this is so important. So then we have all the different elements that we need to build an automation. Yes, we have our rules, we have our theoretical principles that we saw, we have our money management rules. Now, what I did is take all that, build a big algorithm, and then create the tool I will work with to build the automation. And this tool is called the Bumblebee. Yeah, it's a strategy builder. So this will allow me to do a lot of things. Yeah, because it's very customizable. So I can move the different levers as I need to find the right pattern. Okay, so what can I do with the strategy, with this strategy builder, with the Bumblebee? Okay, I can create the automated strategy. This is for MT4, so you will see it now with examples. Okay, I can design my custom plans. Yes, entries, exits, stops, targets, everything we saw before with the money management rules. I can adjust the pattern structure in length and time, as we saw before, because they are connected. I can use 6 to 7 different kind of indicators: MAC, stochastic, fractal dimension, moving average, ATR, pivot points, Bollinger Bands, all the different indicators we saw before in one of the slides. Also, I can choose a trading time. I can choose to trade during the London session, to London and New York, during the overlap of this, 24 hours. Yes, I can see when the pattern is more profitable or not. I can choose that time. This is very important because we have increase or decrease of volumes. Yes, depending on the moment of the days. We, the investors and traders, are more emotional. If, for example, the Fed is going to uh, uh, give notice of is they going to increase or decrease interest rates, yeah, emotions will be there. They will show more in all the movements. So that's everything that you can do with this, and then you can backtest to see if your strategy, your plan works, and then you can put them live to work and let the automation do the rest of the work. Okay, so we have the tool now. We have this Bumblebee that will allow us to create the different strategy for different instruments. So then, how we build that strategy? So we need to first I define. I put 6 different steps that you can find, and in the images you have how the process impact in that strategy. Okay, this example is for the pound dollar with the pattern that we saw before, the very complex motive wave with internal subdivision, simple, complex, and then a corrective wave, simple, that give us a total of 5 waves. So I took that, I put it in the pound dollar. I defined this money management strategy. Yeah, so I will show you how it looked like in an MT4. Yes, I can go here to, okay, I have it here. So expert properties. So I have all these different levers to work my money management strategy, the enter, the exit. So I can enter at this point at 0.7 retracement of the W. I can reach 1%. I will take profit in 0.6 extension of the motive wave, 0.8, 1.3, and so on. And I can select the trading time. Yes. So I can modify all these levers, 0.3, 1. Yes, this is very, you can customize this as you need. That's quite good. So that's a way we start working with the different elements. So we have our money management strategy. We run the first test, and this is what we have. Then we have a lot of The strategy by itself is a profitable strategy. That's something that we like to find, because then it will give us more chances to succeed in the future with what we are building. And then when we start working with the pattern, we take the pattern, we see what are the best relationship in length for that retracement and the time relationship between waves W and X. And when we find, we could found that we have this output. Yeah, we have an improvement of the prior picture. Our strategy is getting better. So that's what we try to do with an optimization of the automation. But the key element, one of the most important things, if we need to keep it simple, so we need to have a reason why we are doing all that we are doing. Yes, we are trying to find, we need to follow these theoretical principles. Yes. So that's why we need to keep it simple. If we over optimize, we will have a very nice back test. That is what we see most of the time in internet. But the strategy is not successful because it was not really built in the right way. So that's why we need to keep it simple. Then next step, we need to find those characteristics of behavior in persistence, trend, and volatility. And we also got an improvement here. And this was backtested in a certain period of time. But then, to see the truth of the strategy, we need to prove it with a period of time that we didn't use before in the future, not in the past. And then we see a nice continuation of the trend and, of course, a positive result. Yeah, so that is a good pattern, is a good optimization. It's quite simple because we have one element to define the different characteristics, and it gives us 87% accuracy, 3.26 profit factor, 1.71 of drawdown. So it's really, really a good strategy. Now we're coming to an end. So with this, you can build a strategy for different instruments, different patterns, and build up your portfolio. And that's what we did. See, you have here some examples of final strategies that are working profitably at this moment. And that gives us a great strategy with a 3.4 profit factor, 2.4 drawdown, and profitable trades of 87%. And everything was built with this great tool that's called the Bumblebee. Okay, with this, you have an idea of how to build an automation. If you want to try this tool, you have the tool in our website, thefinancialforecast.com, in the tab Indicators. Yes, you have access there, and you have here the tool, and you can just learn more, see how it works, test it for some months, build your own strategies. It can work with any kind of instruments. You can work with different time frames. It's really a great customizable tool to create your automations based on, of course, Elliott Waves and fractal theory. And that is all. If you have any questions, you can send it to info@thefinancialforecast.com. It was very nice to have you here, and I see you next time in the coming month with the next webinar. Thank you all. Bye.